what do I do if I've gone to a big fancy bank and I took the right courses in school and I was 60-40 and I got cratered last year like none of us have ever seen? What's the new 60-40 this year given the macro backdrop?
Well, the first thing that I'll say is that, despite the sell-off, the expected return from a 60-40 portfolio today is far superior to where it was 12 months ago, nearly double based on our estimates. What I would say about 2022, the issue at hand, the reason why diversification didn't work was just because interest rates and inflation were at the center of the debate. And the one common variable when you're pricing stocks and bonds is rates. So if you can't figure out what rates are going to be, you can't price a bond, you can't price a stock, everything sells off together. And that was very much the story that last year. This year, you think about what people are talking about, they're worried about recession. They're worried about growth fears. And if we do see those growth fears kind of reassert themselves over the course of the next couple of weeks, I do think that negative stock-bond correlation will reassert itself. And so I'm not so sure the 60-40 is dead. I think that the 60-40 is actually looking better today than it was 12 months back.
I wonder, though, about that downturn that everyone has confidence in. What do you take from the jobs data that we've been getting that indicates a very different picture?
So I think this is what's so interesting. People are looking at the economy in black and white today, and they're saying, growth or recession. And what they don't understand is that the echoes of this pandemic are things that I don't think anybody was really ready to comprehend, right? We have a very strong labor market. We have a housing market in recession. We have cyclical sectors in the economy that are effectively in line with their long-run average. Everything is at somewhat of a different place. And so, I actually think what could bail the economy out next year is a labor market that proves to be more resilient, a labor market that does soften, because that's what the Fed has said they want to see happen. But I actually think that what we're seeing here is just a reflection of these pandemic echoes and a little bit of labor hoarding, right? Businesses not wanting to get caught on the other side of the trade where they were for the better part of the past couple of years with not enough workers, right? So now they're hesitant to let people go.
So why is Mike Wilson wrong then, from your view, in basically coming out and saying that perhaps things will muddle along and we will avoid some sort of big downturn in the economy, but that doesn't mean that stocks aren't going to get hammered. In fact, that actually ups the chance that they will.
So the great debate is about earnings, and everybody has a different take on earnings. A lot of people like to say, well, on average, over the past 75 years, when we've had a recession, profits have fallen by 30%. If you actually isolate the period from the late 1960s through the early 1980s, which I would argue is an inflation environment more similar to the one we're in today, the average decline in profits was 15%. And I'm not Pollyannish, right? I recognize that if we have a recession next year, corporate profits are going to decline. I think it's more about pricing in that magnitude of decline, and I think people may be overly pessimistic, not recognizing what inflation does for revenues.